As of this moment, Plug Power is trading at $3.78 per share, up 3.42% on the day. Now, on the surface, a 3.5% pop might seem like just another volatile day for a notoriously choppy stock. Many will see this and lump it in with general market strength or a slight recovery in the battered alternative energy sector. But that's a surface-level reading, and it misses the critical undercurrent of what's actually happening. Today's move isn't just about sentiment, it's about a desperate search for a bottom, and the market's attempt to price in a future that is becoming more binary by the day. The real story here is whether this small flicker of positive momentum is a sign of life or simply the last gasp before another leg down, driven by forces far more significant than a single day's trading. The common expectation for Plug Power has always been built on a grand vision, a world powered by clean, green hydrogen, with Plug at the center of it all. Investors bought into the narrative of a company building the infrastructure for the future, from hydrogen-powered forklifts in Amazon warehouses to large-scale electrolyzer plants that would supply the nation. This is the story that sent the stock to astronomical highs. The reality, however, has been a brutal lesson in operational execution and financial discipline. The narrative promised a high-growth tech disruptor, akin to the early days of Tesla stock. The reality has been a cash-incinerating industrial manufacturer, struggling with negative gross margins, construction delays, and an insatiable need for capital. The tension between that beautiful expectation and the harsh reality is what creates these violent swings. The market wants to believe in the hydrogen dream, but the company's financial statements keep pulling it back to a very difficult present. This is a critical distinction for anyone looking at this stock on a platform like Robinhood or SoFi Invest, where the appeal of a low share price can often mask deep-seated fundamental problems. Let's dissect the recent price action more closely. This 3.42% gain needs context. We have to look at the volume. Is this move happening on heavy institutional level buying, or is it on light volume, suggesting it's mostly retail traders and short covering? An increase on low volume is often a trap, a temporary bounce that can easily reverse. A sustained move requires conviction, the kind you see when large asset managers, using sophisticated tools from Interactive Brokers or Fidelity, start building a position. We've seen Plug Power's stock price get hammered after every recent earnings report, not necessarily because of the top-line revenue growth, which has often been impressive, but because of the disastrously negative margins and the ever-growing cash burn. The company has been in a perpetual state of jam tomorrow, promising that profitability is just around the corner once their new Georgia and Texas plants are fully operational. Yet each quarter reveals new operational hiccups and higher than expected costs. This is where the trust deficit with serious investors widens. While a day trader on the Robinhood app might play the volatility, a long-term investor using Fidelity Wealth Management for their individual brokerage account has to question the company's ability to ever generate sustainable free cash flow. Furthermore, the macroeconomic environment is an anchor tied around Plug Power's ankles. This is not a company like Apple stock or Nvidia stock, which are gushing cash and can weather any storm. Plug is a pre-profitability company that depends on access to cheap capital to fund its expansion. In a high-interest rate world, that capital is no longer cheap. Every dollar they have to borrow to fund operations costs more, and every share they have to issue to raise funds causes more dilution for existing shareholders. The promises of the Inflation Reduction Act provided a tailwind of hope, but the specifics on how those credits, particularly the 45V tax credit for clean hydrogen production, will be implemented and monetized remain a point of significant uncertainty. This policy risk is a major overhang that sophisticated investors are watching closely. The stock, therefore, isn't just trading on its own merits. It's a proxy for interest rate expectations and government policy execution. For those less familiar with the company's core operations, Plug Power essentially has three main business lines. First is its foundational material handling business, selling hydrogen fuel cell systems for vehicles like forklifts to major customers. This has historically been their bread and butter. Second is their ambitious expansion into producing green hydrogen themselves. They've invested billions to build plants to supply the hydrogen for their fuel cells and for the broader market. The vision is to create a vertically integrated ecosystem, a one-stop shop for the hydrogen economy. The problem is that building this ecosystem is incredibly capital-intensive, and so far the returns have been deeply negative. They are selling products and fuel for less than it costs them to produce, a classic growth-at-all-costs strategy that the market no longer rewards in a risk-averse environment. An investor looking for stable returns might be better served exploring broad market fidelity ETFs or a managed solution like Schwab Intelligent Portfolios, rather than taking on the binary risk of a single company struggling with its core business model. For those committed to self-investing, understanding this margin compression is absolutely critical. Looking toward the future, the bull and bear cases are stark. The bullish scenario, the expectation, is that Plug finally turns the corner. It's a world where their Georgia plant ramps up to full capacity and produces hydrogen at a cost low enough to generate a positive margin. It's a scenario where they sign several massive new electrolyzer deals, proving the market for that technology is robust. It's a future where their cost-cutting measures take hold, their cash burn slows dramatically, and they begin a clear path to profitability without needing another massive dilutive equity raise. In this world, the stock is profoundly undervalued, and today's price will look like a historic buying opportunity for those doing their online investing. The bearish scenario, the reality check, is far more sobering. It's a future where operational issues continue to plague their new plants, where hydrogen production costs remain stubbornly high due to volatile energy prices or technical difficulties. It's a world where competition from other hydrogen players and even from battery electric solutions intensifies, squeezing margins even further. The greatest risk of all is the balance sheet. If the cash burn continues at the current rate, the company will be forced to raise capital again, likely at depressed prices, which would severely punish existing shareholders. The risk of insolvency, while not immediate, is no longer a fringe concern if they cannot fix their negative gross margins. This is the central conflict that will define the stock's performance for the next several years. Comment below what you believe Plug Power's biggest hurdle is to achieving consistent profitability. Is it technology, operational execution, or market demand? In summary, the 3.42% rise in Plug Power today is far more than just a number on a screen. It represents a single data point in a much larger and more dramatic story. It is the story of a company caught between an inspiring vision of a clean energy future and the brutal financial reality of making that vision pay. The expectation is that of a pioneer, an industry creator. The reality is that of a company fighting for its financial life, squeezed by high costs, operational challenges, and a difficult macroeconomic backdrop. For anyone considering an investment in this name, whether through platforms like Interactive Brokers or SoFi, the key is to look past the daily noise. You must weigh the enormous potential of the hydrogen economy against the very real and present danger reflected in the company's financial statements. The final outcome is not yet written, but understanding this deep-seated conflict between the market's hope and the company's operational truth is the only way to make an informed decision. Disclaimer: this content is for educational and informational purposes only. It is not financial or investment advice. Please do your own research or consult a licensed financial advisor before making any investment decisions. Don't forget to like, comment, and share. Subscribe for more finance updates and market insights.